before we had our Chinese New Year holidays, yeah, we talk about different costs. Okay, yeah, because when you are trying to manufacture products, okay, so there are different costs that you have to go through. And yeah, so it's just a very quick recap, and you can see there are two costs. Okay, so when we talk about variable costs, okay, hi, hi. Oh yeah, 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 yeah. But here I'm just trying to make a quick recap before we go back to that break-even analysis assumption. So yeah, very quick. Okay, very quickly. Okay, so yeah, variable costs. Okay, so once again, yeah. So when you talk about variable costs, think about this. Use this case as an example, right? So if you are trying to produce ice cream, okay, you need raw material, right? Yeah, and yeah, and that's the case when you need more, when you need to produce more ice cream, you need more milk. Okay, so that is actually your variable cost. That is your raw material, because when you have to increase the output of ice cream, you need to get more milk, right? And in that case, your cost is going to increase based on the output. The more output you have, the more milk you have to purchase. And at the end, right, when you look at the definition of variable cost, you can see it would change directly, okay, as the output changes. Okay, so that's variable cost, just like what the name describes. Okay, and fixed cost is just the opposite. We don't care about the output anymore. Okay, so it doesn't matter how many output you have, you are going to pay the same cost for something. Okay, so let's say the best example will be the rent. Okay, rent, it doesn't matter like how many output that you have. You just have to pay the same rent every month, right? Yeah. So that's variable cost and fixed costs. Okay, and that's why. Well, once again, if you talk about the total cost, basically we're trying to add up all the fixed costs and all the total variable costs together, then that's what we call a total cost. So that is, you know, the sum of every cost that we have in our shop, in our factory. Okay, and very logically, if we want to find out the average cost, you just have to use the total cost divided by the total output, and that's how you find the average cost per unit, right? So that's average cost. All right. So this is what we have to know for now. You see, the fixed cost, the variable cost, the total cost, average cost, and then we also have revenue. Okay, the revenue is just the same concept, total revenue. Yeah, you just have to add up all the sales together, then you will get your total revenue. Okay, and that is where we can find out, okay, our break-even point. Okay, because when you look at this break-even analysis, right, once again, is when the total cost and your total revenue is the same. Okay, so when they are the same, then you will see you are going to get zero profit, right? Because your revenue is the same as your total cost. Okay, so you are going to get zero profit, right? But why is this so important to our factory or to our business? Because we want to see how many output that we should produce in order to make a draw, right? In order to lose nothing. Okay, so that's why we want to find the break-even point. Okay, all right, okay, so that's the importance of break-even analysis. All right, we try to find like how many output we should produce or how much sales we should make in order to make a break-even position. All right, yep, so that's what we call a break-even. Okay, yep, and yeah, you had that before Chinese New Year holidays, so I'm just gonna skip this. And yeah, and then we come back to this. So this is the assumptions that we have to make before we start using break-even analysis. And I can tell you, basically, okay, well, I just told you the benefit of break-even analysis. So that is to be able to find out like how many output or how much sales we have to make in order to make a draw, in order to make no loss, right? And I can tell you, the limitation of break-even analysis is basically from all the assumptions here. Okay, so yeah, you think about this, right? So let's go to the first one. All right. So the first one here, we have to first assume the fixed costs, they remain unchanged. Okay, because from the definition we know that the fixed costs will not change, no matter how many output we have. Okay, but sometimes you will see something like this in the real world. Okay, so let's try to yeah, you see, because of this, okay, because of this coronavirus, I'm actually learning a few more softwares. Yeah, try to upgrade myself so that I can do a better presentation in the classroom. So let's see if we can use this. So this is actually uh, an iPad mirroring display software that I found a week ago. I don't know if it works, but well, let's see. Okay. All right. So yes, are you guys able to see a different screen? Yeah, yeah, okay, oh, that's good. All right, that's great. So basically, this is actually my iPad, the screen of my iPad. So yeah, so when we talk about fixed costs, so we first assume the fixed costs they remain unchanged. But in the reality, in the real world, yeah, you can see why we have to make such assumption. So in the reality, so let's draw. Uh, yeah, yeah. Are you able to see? Oh, wow, my handwriting on the iPad is terrible. Well, anyway, yeah. So you can see every time when you're trying to draw a diagram for cost or revenue, you just have to remember the axis that you're writing. So for your y-axis is going to be, if you're talking about cost, it's going to be cost. Yeah. And for the x-axis, it's going to be your output. Okay, yeah. Are you able to see my drawing? Yeah, yeah. Okay, that's cool. Right. So yeah. So basically, when we were talking about the definition, the fixed cost should be like this, right? Like a horizontal line, right? Because it makes sense. It doesn't matter how many output that we have, we pay the same cost, just like the rental cost. Okay, yeah, it doesn't really matter how many output that we produce for our product. We just have to pay the same amount of rent. Okay, so that's the thing, right? But now when we are doing our break-even analysis, we try to make assumption that fixed costs remain unchanged, because in reality, you will see sometimes. Wait. Yeah, sometimes the fixed costs, they look like this. Yeah, right. Yep, it's like a ladder. Okay, yeah, guess why? 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 Yeah, why? Inflation? No. Why? Come on, think about this. Yeah, right. Yeah, yeah. Let's use the same example, the rent. Yeah. Well, Gordon, you're actually having the same. I mean, you're actually having the correct idea. So yeah, you need more space. Okay, so that's why in the reality, okay, think about this, right? So if I'm trying to produce a specific amount of goods, then the fixed cost should be a horizontal line. But there should be a point where, let's say, that factory is not able to satisfy your current output anymore, and that's why you have to find another factory. And if that's the case, then you see here, yeah, so that is actually the point. Yeah, you feel like, yeah, I need another factory. And if you have your second factory, then the rental cost, of course, is going to go up, yeah, immediately, right? And go on and on and on and on based on the output that you are increasing. So that is, yeah, so that's basically in yeah, in the reality, that is what you will see. But you know what? This is out of the syllabus. Okay, I'm just trying to use this as an explanation to show you why we have that assumption. Because if you use this assumption, if you ignore this assumption and you use this kind of curve for your break-even analysis, you're gonna find it very difficult to show the answer or to show the analysis, because when we are trying to use analysis, we are trying to find an easier way so that we are able to get some reference from the analysis. We are not really trying to find the absolute answer. We're trying to find a reference. Okay. Yeah. Yeah. So that's why we have to make that assumption. Okay. Yeah. So that's one. And if we go to the second one, yeah, the variable costs vary in direct proportion with production level. Yeah. So let's talk about the milk that we just said we just used in the very beginning. Yeah. The more ice cream that you want to make, the more milk that you need. So why should we make that assumption then? It doesn't really matter, right? Even if we don't make that assumption, it should be the same as this one. But you need to think about this, okay? Variable costs, yeah. If you are talking about bulk purchase, right? Okay. So if you buy a lot of stuff, yeah, buy a lot of milk at the same time, yeah, it's going to be cheaper, right? And that's why it's not going to go upwards. The curve is not going to go upwards proportionally if that's the case. And if you consider this as a factor as well, the analysis is going to be so difficult to make it happen. Okay, so that's why we have to use this assumption here. Yeah, variable costs vary in direct proportion with production level. Okay, to make it easier, yeah, for the businesses to understand where the break-even analysis is. And that's why I told you all of the analysis, all of the assumptions here, they are actually the limitations. Yeah, yeah, because you can see in the reality, things just don't work the same. Okay, yeah, as that's what we have learned here. Okay, and then we go to the third one. All output is sold without any inventory remaining. So yeah, we are trying to make things easier. So we just assume whatever unit that we have produced, we can sell them all. Okay, so that is easier for the presentation that you will see later on. Okay, and number four, the only factor affecting cost and revenue is just the volume. Okay, but in the reality, there are so many different other factors that affecting the cost and revenue. Okay, let's say the efficiency of the using the resources. Okay, and if that's the case, then the curve is not going to be linear. It's going to be it's not linear. Okay, so yeah, all in all, we are using these assumptions to make things easier, so that when we take a look of the break-even analysis, it's easier to find out the answer. Okay, so here, let's try to do some quick exercise. All right, so now you can actually unmute yourself, yeah, if you are answering the question. Okay, so here, take a look of this question here. All right, yeah. So assuming that we are selling the toy chicken, yeah, all those chickens over there, right? They're very annoying when you squeeze them. Okay, yeah. I'm sorry. Yeah. Assume the business can sell all the goods, right? Because that's one of the assumptions, right? So here, these are the items. We have fixed costs. So that's the total fixed cost. Okay, so that's the total fixed cost, $100, and the variable cost per unit, $2, and production, 20 units. So right now we are producing 20 units. All right, and the selling price per unit is $5. So here is the first question. So the first question here is, what is the total cost at 20 units? $140. How do you get that? Yeah, exactly. That's how you get the total cost, right? By adding the fixed cost and the variable cost together, the total fixed cost and the total variable cost together, then you will get 140. Yeah, easy, right? Yeah. Okay, let's go to the next one here. Right, what is the current sales per month? So right now we are talking about this, the production per month. So here, current sales per month, what is it? 100. Yeah, right. Using the 20 units, that's our production, because we have made the assumption that we sell all the units that we produce. So that's why we are selling 20 units, right? And we are selling the product at $5. So 20 times 5, that is 100. Easy, right? Yeah, so let's go to the next one. Okay, so is there a break even in this case? No, right? Yeah, you can see that clearly. So the total cost 140, and then the total revenue, so which is 100. Okay, so right now, if we are selling it at $5, okay, at 20 units, we cannot get a break even. We are losing. Okay, we are losing $40. Okay, so what should be the break even selling price at 20 units if that's the case? Yeah, so what is the selling price if you have to make it break even at 20 units? $7. Yeah, that's what you can find. So this is actually what the break even analysis trying to help you. Okay, yeah, first you do your analysis, and now you know how you should adjust your business in order to make. Oh yeah, yeah, sure, sure. If you ignore other factors, when you are increasing the price, right? I don't think people the good is it will be less attractive to the people. So if you ignore that, then yes, of course, if you increase the price, then you will be able to get break even or even get a profit. So yeah, but yeah, you see here that is what the analysis is. Okay, the analysis is trying to help you to get something like this. Okay, to change the price or to adjust the production units. That's break even analysis. Okay, so here we have. So this is basically what you will see in your exam. Okay, so there is a question sometimes. Yeah, hopefully this is going to be your exam, because it's so easy to finish this one. Usually this one is worth 4 marks. If you are able to do that, then you will get 4 marks immediately. Okay, so yes, well, a little bit, yeah, but it's also business. Okay, so yeah, so this is the overlapping point between economics and business when we talk about this unit. Yeah, the production cost and revenue. Okay, so here, so very quickly, if I have to draw fixed cost, total fixed cost, how should I draw it? Yeah, how should I draw it? So once again, the y-axis, yeah, we talk about the revenue or the cost, and the x-axis, we talk about the output. Yeah, so in this case, because it's a surface, yep, high, yeah, 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 400, yeah, exactly, yeah, thank you, right? So because when you see the questions here, weekly overheads, so you could say that's weekly expenses, right? So that I mean they are the expenses. It doesn't matter how many output that how many customers that you have during the week. You have to pay $400 no matter what. Okay, so that is basically your fixed cost. Okay, so for your fixed cost, Jesse is completely correct. So you just have to draw a line, right, like this. Yeah, can you see the line? Yeah, yeah, yeah. So that's your fixed cost. Well, it depends on how they describe the cost. Okay, but here, because they said weekly, weekly overheads, so is like a routine cost weekly. Okay, so we assume that's a fixed cost. Okay, but of course, overhead is just a general term. You could say overhead is equivalent to cost. Okay, but we don't use the name to define if that is fixed cost or variable cost. We use some other clues like weekly here to see. Okay, so that's the fixed cost, right? Because no matter what, no matter how many customers you have to pay $400 per week. So that's fixed cost. All right. So variable cost. So how do you draw your variable cost? Total variable cost. So now we have variable cost per customer, $2, and we have the number of customers in that week that we have served. So how do we actually draw the variable cost in this case? Anyone? So you need to find 2 points. Which are the 2 points? That don't know. All right, okay, I'll show you. Yeah, it's so simple, right? It's just like the basic math that you have done, along the years. So, if you are drawing a curve, right, you need to find points. Okay, all you need is 2 points. So, let's say if you are producing nothing, okay, if you have 0 customers, what will be the variable cost for that week? If you have 0 customers, what will 0, right? So that is your first point at 0. So that's 1 point. Yeah. So now we know 1 point. And then when we look at the question, yeah. So this week we have served 60 customers, and the total variable cost when we serve 60 customers is and 120. So yes, so now we are actually able to find the second point in the graph. So this is the first point. Yeah, if you are able to look at my cursor, then you will see this is the first point. And then when we go to a 60, so this is the output that we have sold for this week. At 60, the variable cost is 120. Okay, so go up, go up, and yeah, somewhere around here. Okay, so that's your variable cost. So if you line the 2 points together, 1 and 2, then you will get your variable cost curve. All right, is that clear? Just like this. Yeah, it has to be curved. So yeah, you see here, if I line this point with this point, then you will get this line. Right? So that's how you get your total variable cost. All right? Yeah. Is there any questions? Cool. Okay. Well, I think I have to move my Google Meet window to another screen, because when I'm using the presentation mode, I cannot actually see your chat box. So don't mind me. Yeah. Okay. All right. Yep. Okay. So yes. So now I can see. All right. So Chloe is keep disconnecting, I think. Well, anyway. Yeah, multi screens. Yeah. Okay. So forget about it. Okay. Yeah. So that's variable cost. Okay. So if you wait. So now you have your fixed cost and you have your variable cost. So now we have to find the total cost curve. So where is the total cost curve? Yeah, the variable cost, just like the variable cost, okay, the line is the same as the variable cost, but it starts at 400. Yes, 400. Okay, so because think about this, total cost is when you're using variable cost plus fixed cost, and if you are producing a 0 unit, your variable cost will be 0. But at the end, you still have to pay that $400. So with that being said, your total cost at 0 will be 400. Okay, so it's so simple. You just have to put another curve just like your variable cost. Yeah, same pattern. right here, just like this. So you can see it's parallel. They are parallel. Yeah, you see that? They're parallel. Okay, because you see here, the gap here. What is the gap here between the total cost and the variable cost at any point? Yeah, what is this? What is this gap here? Yeah, the 400 fixed cost. Exactly. Okay, so that's why, that's how you get your total cost. All right, and this is, well, here, direct, yeah, relationship, right? So the more output you have, your variable cost should be higher, right? So you have to buy more milk for your ice cream. Okay, so that's variable cost, and if you add them up together, this gap here, that's the fixed cost, the 400. So you can actually count the boxes to find that 400s. Okay, so yeah, so that's how you find the total cost. Okay, but in the question, usually they will only ask you for the break-even point. So basically, well, yeah, you do need to draw the variable cost, the fixed cost, and yeah, after that, you are able to find the total cost. And now you have to find the total revenue. Total revenue. So you see here, uh, this week we are selling to 60 customers, and we are selling it at $10 per customers. So yeah, same concept. At 60 customers, we have the total of 600 revenue. Okay, so yeah, if we go to 660 here, yeah, and it will move up to 600. So that's 1 point. Okay, and yeah, same logic here. If you are selling 0 unit, then you will get 0 revenue. So that is your second point. All right. So basically, you have 1 point here, and then the second point here. So if you line the 2 points together, then you will find the revenue curve. Okay, just like this. Yeah, by lining this point and this point together, right? So you are able to find the total revenue curve. Okay, so where is the break-even point? Yes, somewhere around here. So in the intersection point, that is your break-even point. Okay, because you see here, before that, take a look at this. Your cost is higher than your revenue. Yeah, right. Yeah, your cost is higher than your revenue at 20, at 40, at 30, at 10. Okay, and you can see that after the break-even point, your total revenue is higher than the cost at 60. You see, the total revenue is higher than the cost, and at 80, the total revenue is higher than the cost. So you can find out that at the intersection point, we know that the revenue is equal to the cost. Okay, yep. So that is your break-even point, and that's how you finish this question, right? And that's how you get 4 points, just like that. Okay, yep. So, any questions? All right, if you don't have any questions, I assume you are all right with that. So now let's do an exercise. So here, I have another question for you. So you can capture the screen, okay, capture the screen and then draw it on your laptop. All right, I'm gonna give you 4 minutes. All right, 4 minutes, and then we'll go through the answer. Okay. Wait, what? Yeah, when you have finished your graph, can you just give me a heads up? Yeah, try to type done in the chat box so that I know. someone is hanging the clothes or something. And I can hear the sound of iron. Like, well, uh, yeah. Was it again? Well, not really. Well, yeah. I mean, for the sake of the learning, you need to draw the fixed cost and variable cost first, and then yeah, then draw your total cost. Yeah, just like that. Well, but you can actually just draw the total cost curve. Is yeah, is you just have to find that 2 points, the total cost at 50 customers, and because it starts at the fixed cost, so you have the second point. So if you do that, then you can just skip the working for the variable cost. But now, yeah, since we are learning, so you can draw the variable cost curve first. Yeah. All right. Is everyone okay? I believe everyone is here. All right. Okay. Oh, that's quick. All right. Yep. Okay. So I'm going to show you the answer. Well, yeah. So when I'm showing you the answer on the screen, because what I cannot pinpoint, the points in the PowerPoint. So sometimes the lines might be a bit off. Yeah, but it's almost the same. Okay. Yeah. So just bear with me. All right. Okay. All right. So the fixed cost here. So what is the total fixed cost? 320. Yep. Okay. So you are going to draw a horizontal line just like this at 320. Okay. Yeah. Just like that. Right. Easy. And then what about the variable costs? The variable costs 350. Yeah. So 7 times 50, then you will get the number at 50 and 50 customers. Then you will see 350 as the variable cost. And then because when you have 0 customers, then you have 0 variable cost. So that's why you are going to have a curve similar to this. Okay, so if you're able to find all those 2 curves, then you'll be able to find the total cost curve. All right, so you just have to move up this variable cost curve to the fixed cost here. Right, so it starts at the fixed cost here. Right, just like this. Then you will be able to find the total cost. Right, so you see once again the gap here, it is the fixed cost, the total fixed cost, the 320 fixed cost, right? And then you just have to draw yourself a total revenue curve. Okay, so what is the total revenue curve for this week? I mean, the total revenue for this week. What is it? 750. Yep, right? Yep. So 15 times 50. So you'll get that point. at 50, yeah, here at 50, you will get 750. And then when you have no customer, then you have 0. So line the 2 points together, then you will find the total revenue curve, right? And then the break-even point will be, yeah, somewhere around there. Okay, so just like that. Okay, or you can use the customer as the answer, or you can use the total sales as the answer here. Okay, yeah, so it doesn't matter. Well, it will be great if you can write both of them in your answer. So this is your break-even point, just like this. Okay, yeah. Any difficulties? Any? Yeah, yeah. Oh, yeah, 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 yes. So this is yeah, yes. Well, you just have to adjust it. Use your right. I mean, I know what you're trying to say, because you cannot really find that 320 in that box, but you just have to make it as close as possible to that 320. It's okay. It's okay. We allow it's a little bit of margin of error, so it is all right. It's no big deal. Yeah, yeah, yeah. All right. So yeah, so that's how you find the break-even point. So that's it. That's it for the break-even analysis. Yeah, it's that simple. All right. Any questions? Nope. All right. If there's no questions, then we will move on. Right. Move on. Yep. So basically, we have one more thing that we have to learn for break-even analysis. So which is the margin of safety. So margin of safety is a very simple concept. So basically, we are trying to find, okay, the margin of safety. Why? Because we want to see the current sales. If we are having, a specific current sales, okay, how much loss I can afford before I incur a loss. So this is the margin of safety. Okay, so this is the beauty of margin of safety. Okay, so if you look at the screen, you will see, okay, margin of safety is basically when you're using the current sales minus the break-even sales, then you'll be able to find that gap. So that gap is where the buffer. Okay, that's the buffer that if you're the business, okay, you have that range of buffer that you can afford to lose, okay, before you incur a loss. So here, a very simple example. Yep. So let's say the current sales is $1,000, and the break-even sales, because of the break-even analysis, we know is $900. So the margin of safety will be $100. Okay. So we still have. So right now, when we're selling, at the total sales of 1,000, we still have 100 buffer until we incur a loss. So that's the meaning of margin of safety. Okay. Yeah. Just like this, right? So yeah. With that being said, the business has $100 of buffer before it will have a net loss, right? Because if we go beyond that break-even point, then we'll have a loss, right? So yeah, we still have $100 remaining, okay, to that break-even point, and if we go beyond that point, then we'll have a loss. Okay, yep. So that is margin of safety. Yeah, that's all for margin of safety, right? So it's just a sub function from the break-even analysis. Okay. Break-even sales. Yeah, yeah. So the break-even sales is the break-even point. So you can see at the break-even point, you are able to find the break-even output and also the break-even sales. So in that case, that is the break-even sales. Okay. Yeah. So when you are showing the break-even point, you can show both break-even sales and break-even output. All right. Yeah. Just like this. Okay. All right. Yeah. So let's wrap this up. Okay. So yeah, once again, every time when you are learning different concepts, there will be benefits and limitation. And well, you can see, the benefits and limitations clearly. Okay. So for the benefits, yes, you look at the red color highlighted words. So they are basically the keywords. Okay. Yeah. So when you think about break-even analysis, It's so simple. Yeah, you don't need to consider other factors at all. You just have to consider the cost and the revenue themselves. And that's why it's so easy to construct and to see the break-even point. Okay, because we're using the assumptions. Easy to find a reference from that break-even point. And because of that break-even point, it gives you a guideline. Yeah, how many output you should sell, how many how much more sales remaining in the buffer before you incur loss based on the margin of safety. Okay, so yeah, so you can see some guideline from both break even analysis and also margin of safety because of that. So it will give your business some ideas like what we should do and what we should adjust for the price, what we should adjust for the output in the coming future in order to make things better. Okay, yeah, and finally you can see right the effects because when we are drawing the curves, we can find out the effects. Okay, when the cost is getting higher, what will happen? Let me rephrase that. When the output is getting more, what will happen to the cost? What will happen to the revenue? So it shows you some effects. Okay, on both cost and revenue. Okay, yeah. So basically, after all the practice, then the benefits they are very obvious. Okay, it's easy to use based on the assumptions, and it gives you a guideline for the break-even point and the margin of safety. And also, when you look at the diagram, it shows effects. Okay, of the change in cost and revenue. Right? Yeah. So that's all the benefits and the limitations. Once again, like from the beginning of the lesson, I told you the limitations. The only limitation is basically from all the assumptions because all the assumptions. Okay, we try to ignore so many other factors, and if we want to make things more accurate, we of course we have to consider those other factors, and that's why it becomes the limitation of that, of this break-even analysis. Okay, yeah, and the examples I just told you, all the examples for each assumption. So use them in your answer. All right, so that's what it is. Okay, yeah. So the benefits and limitations. All right, simple concept. Okay, yeah. And yeah, so we still have 10 minutes, I think. So yeah, so right now let me introduce the second topic of this chapter. So yeah, so basically we are halfway through for this chapter. This chapter is so short, okay? So yeah, so now we have learned about the cost, the revenue, the break-even analysis, and margin of safety, right? Yeah. And now the second topic of this chapter will be something the economic students have learned already, and that is the economies of scale. Okay. Yeah, of course, for business students, we do hear about this from time to time. Okay, but we don't know the detail about this. Okay, so what causes economies of scale? Yeah, as a business student, we know that if we produce more, then our average cost will be lower. But what caused that effect to happen? So this is what we are trying to find out. Okay, so here, this is the very basic average cost curve that you will see, in your econ textbook or in your business textbook. So once again, look at the axis, y-axis, because it's talking about the cost, so it's a cost axis, and then your x-axis is talking about the output. So you will see this. When you have more output, the cost will get lower and lower. Yeah, and that's why we call that economies of scale. Here, the first part, right? Yeah, and when we get to point 8, this point here, this is where we can get the minimum average cost, right? Because here you can see that's the lowest point of your average cost. So yeah, so that cost here, the C right? That's equal to your minimum average cost, yeah, or you can say that's the maximum economies of scale, because that is where you can utilize your economies of scale to the maximum. Okay, yeah, right. So that's it. Okay, so here you can interpret the output this way as well. Uh, when you go right, okay, it means that you're having more output in your company, but also it means the size of the firm is getting bigger and bigger. Okay, so here when you go right, the firm is getting bigger and bigger. You have more factories, you have more offices, you have more machines, blah 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 blah. You have more labor. Okay, so yeah, this is another interpretation. So this is easier to understand what economies of scale is, right? Because here, when you have more resources, yeah, because of some reasons, well, we will talk about it very soon. That's why you will have economies of scale. There will be lower average cost. But if you have too much resources, if your firm is getting too big, okay, something unpleasant will happen. Yeah, when your firm is getting too big, and yeah, use your common sense, and you know what they are. Okay, so before we go to the details, because we're running out of time. Okay, we only have 5 minutes left, so I'm just going to introduce the factors which cause economies of scale very quickly to you. Okay, yeah, if you're econ student, then you know there are so many factors affecting this, which cause economies of scale. But yeah, you need to find yourself a good way to memorize the points. So here, there's one. So what causes economies of scale? Well, I can tell you the answer is this. Okay. All right. I don't know if that helps, but hey, think about this. Yeah. Has your mom ever made you a pizza? Yeah. If your mom hasn't, then she's not a fun mom. Okay. And you see, that's why really fun moms try making pizzas. That is what we are trying to get. Okay. So that is why we can get economies of scale. So why is that? And look at this. Yeah, well, I'm just trying to, use some random sentence, okay, yeah, to show you the different factors. So yeah, so you can see, it might work for you, it might not work for you. You just have to find yourself a better way to memorize this. Okay, so this is what I do. Okay, when you have so many things to memorize, you just have to find yourself some catchphrase. Okay, and then you will see, because of all those 6 factors, we have a lower average cost, which is the economies of scale. Okay, yeah, you can see, because of risk, financial aspect, managerial aspect, technological aspect, marketing aspect, and purchasing aspect. Then we will get lower cost. Okay, yeah. So that's it. Okay, yeah. So try to make your own catchphrase. Okay, yeah. Whatever makes you makes it easier to remember so many things. Okay. Yeah. So we have 2 minutes left, and I think I'm going to stop here. So next lesson, I'm going to explain what are those, why all 6 factors they will make the average cost lower when you are increasing the size of the business. Okay, yeah. So I'm going to stop here, and before I go, I'm gonna give you some homework. Okay, so you do your homework. Yeah, I'm sorry. Yeah, because the exam is coming up, and yeah, it's for your own good. Okay, so yeah, so I'm gonna upload another past paper on Google Classroom. So finish it. Before next week, Monday. Okay. Yeah. Yeah. Another one. Yeah. It's going to be more and more. And it's going to be another one and another one. Yeah. There will be endless of past paper practicing. Okay. That's what we do. Okay. I know it's kind of sad. Okay. But that's how we do it. Okay. Yep. Yes. And remember, if you haven't handed in your homework, yeah, your Chinese New Year holiday homework, please, okay, hand it in on Google Classroom. Okay. Yeah. All right. And I'm going to mark them. All right. You hand in tonight. All right. Yeah. Come on. Yeah. You're supposed to hand it in. Like last week. Yeah. Assuming that we didn't have that suspension. All right. Yeah. Anyway, guys. Right. Yep. Okay. Right. Yeah. So just keep checking your Google Classroom, and yeah, you'll find more and more information. I'll try to post more, materials on the Google Classroom, and yeah. I think that's all, guys, for today. And yeah, and later on, I'm gonna upload the video on YouTube. So yeah, so you can just go back on YouTube and watch the lesson if you want to. Yeah, if you want to listen to my. Whoa, Gordon, what did you just say? I mean, this is not cool. Okay, yeah. So if you want to go back to YouTube and watch the video, yeah, I'm gonna send you the link. Okay. So before I go, yeah, of course, because it's going to upload to YouTube, then I think I should say this. So don't forget to subscribe to my YouTube channel, and yeah, if you have any comments, right, just put your comments in the comment section below. Well, you will see. Okay, when I send you the link, okay, subscribe it. Okay, no, I'm just kidding. Okay, you don't need to subscribe it. You can see it, right? This virus is making workers more efficient because they are learning more skills. Now I can actually become a crappy YouTuber or something. Yeah, but well, yeah, just like this. All right, yeah. The time's up. Okay, yeah. So I'll see you guys next time. All right. So okay. All right. Bye, guys. Bye.